Good morning, ladies and gentlemen. I think last week was a very interesting week for both what the market did and what it didn't do. I think what markets don't do is just as important as what they do. Anyway, I'll explain that later in detail. Uh, we are still in mild risk on. So every daily score is slightly more positive than zero and slightly less positive than 50, which basically has made the daily model go into risk on, and as we are in a new month, it has made the monthly model go into risk on. We're still risk off in the weekly model, but that, as we can see from the scores, will, unless something happens, will tip off into positive territory next week. So as of the end of next week, unless things change dramatically, and it looks like we are definitely not changing dramatically, we will be in risk on in all three models. As far as deviations are concerned, absolutely nothing new. It's just continuing a nice smooth uptrend, much like in this area here. In the sectors, again, nothing, and this is what is surprising me, none of the sectors are really leading apart from XLK. In fact, none of them are doing anything. The transports was boosted by UPS, but it's nowhere near as bullish as the S&P overall. Utilities are doing very, very little, even though yields are coming down. XLB, if anything, it backed off slightly. And the only one that's really maintaining a steep uptrend is XLK, and that is now quite close to the red area. But it's the only one actually that is making these bands go upwards, i.e., expanding them as opposed to contracting them. Every other one is actually contracting its bands. XLF, resting on the middle line. It's just amazing how not even XLV can manage a bit of a steeper uptrend than this one, just basically mirroring what what the middle line is doing overall. And XLP, nothing to write home about. XLY, even though it was boosted so much by Amazon, nothing really to write home about. It's a better uptrend line than many sectors, but it's really nothing spectacular, and that is what's surprising. I think these red lines are going to do very well. As soon as a sector goes and hits it, it's time to rotate out of it. It's been holding for such a long time, and it's been so good to us that I think there is no reason to suppose that this will not continue. But the surprising thing to me, and basically what I'm used this for, is how reliable it is to show you when to rotate out of certain sectors. And the other thing that it shows me is that this whole rally basically is XLK. You can almost forget about the other sectors and just look to time XLK. Are the bond markets giving us any clues? Absolutely none, and I think the bond markets are dead for the summer. August tends to be a very good month seasonally for bonds as inflows come in, but also it's because it tends to be a risk-off time. Is that going to hold true in August of 2020? Who the hell knows? I'm not a great believer in it. But as long as this market stays above 30 to 35, these lines are not going to change ever. Then I think that there is nothing much that the market is telling us. What would it say if it starts breaking below 35, below 30? And this to me is pivotal. 30 to 35, if it starts breaking underneath, then there is something really bad going on. I doubt that the 10-year note can really break down below the 40 basis points area, because that's what this would be implying, without there being a really good reason. Uh, I'll have a look at another couple of bond market spreads, but really the bonds are really not giving you any clues at the moment. This might change, but this is probably the wrong time to be looking for bonds to give you much of a clue. I think a much better spread to look at the moment is the 530s. Got out right at the bottom, just about, maybe a couple of basis points out of it. What do I think? I think this 81 level now is very, very, very important. I still think that that spread is going to widen out to about 150, 155 basis points, but it's going to take a long time doing it. A long, long time. That's what I said several weeks ago, if not months, and I will hold on to it. I think the next risk reward level to trade is 81 basis points in 530s, 80, 81, and we go for a steepener. But until then, this is much of a muchness. It's really nothing. But what it does show you is that we will be approaching very pivotal levels in the spreads, in the bond spreads, and we're talking about 30 to 35 basis points in the 2s, 10s, and we're talking around the 80, 81 basis points in the 5s, 30s. We are approaching them, and that is probably going to be the big crossroads when the market decides whether it's going to be in very aggressive risk on or not. Okay, I said that it's more interesting to me, or just as interesting, to see what the market didn't do as what the market did. Well, one of the main things that it didn't do is close below 93.14 in the DXY. Is the DXY oversold? Yes, it is, but when things get into trend, I really don't much look at those indicators, because you can always go further. What do I think is going on? I think basically now this box, 93.14, 92.62, is very, very important. You can see how the market respected it many, many times in the past, and the market does have a memory. We have the Bollinger Bands on the weeklies. We've far exceeded those, and therefore some sort of a oversold bounce, dead cat bounce, call it whatever you like, to these levels. As you can see, I've basically just drawn a Fibonacci retracement from the high there. We're looking for around 95 on the 50% retracement, maybe only the 0.382 retracement, which is 94.54, but we're looking definitely for some sort of retracement to get into position again. I mean, I covered a lot of the positions I told you, 93.14, maybe a little lower for some of it, but I now think that if we are at a crossroad, either the dollar is going to set the tone for this whole thing and basically get substantially weaker, or it's not. It's not going to stay around these levels. It's either going to go all the way back up to around 98.50, or it's going to break and it's going to continue down and possibly get down to as low in the 80s, somewhere like that. What we're not going to do is we're not going to stay around here. We won't be here in 6 months, put it that way. That's what I think. And if whichever one of these two prevails, and I think the downside, because I think that is the one that politically suits the US most, then we are looking at completely different scenarios evolving over the course of the next 6 months. And I think the likeliest, as I just said, is that we do break down at some stage. Let's have a look in detail what that means actually for Euro USD and what levels we're looking for there. We're actually lucky that it's a new month, and therefore we're going to get new monthly candles. Now, we're above the Bollinger Bands by a little bit on the monthlies for Euro USD, no big deal. I would really love to see a retracement around 115.70, 115.50. At 115.75 I'll be active. Um, Looking to buy call spreads on a 6 month basis, looking for 128ish. If you say that this is going to be some sort of an ABC retracement, it still gives you 128. And this level here, you can see how many months we bounced off this level. What's that? 127 and a quarter. Um, that's the kind of level that you are looking for this pattern to play out towards. If we look at it on the weeklies, I think this is what it's so interesting that it has not done. It has not closed above 118.40. I think now some sort of a U pattern, maybe it doesn't get to 115.75, maybe 116 and a quarter, something like that, 3 or 4 weeks, and boom, it goes back up. Mirrors something like this, and we do 1, 2, 3, 4, 5. That is the kind of thing that is possible. If we look at the dailies, you can see how actually how overbought it got. So it's not really surprising that it couldn't maintain that. But it's a reversal Friday. Will it be the top? No, I don't think so. I would really love to see it 115.50 to 116, whatever you like to call it, 50 basis, 50 ticks, who cares? This is the kind of level that I would like to be a major buyer of it. That will just adjust all these very overbought indicators. But I think we're going to go back in a strong trend because it just makes political sense that they juice up the stocks via a lower dollar. Gold is doing exactly, basically paralleling, bonds and the dollar. While the bonds are as strong as they are, while TLT is strong, and while the US dollar is weak, it's silly to be looking for gold to weaken. But gold also, just like TLT and on a spread 5s to 30s, and the dollar, they're all at very pivotal levels. Either it all breaks and therefore gold keeps on going and keeps on going a lot, or now we have a retracement and then gold comes back to around these moving averages to around 1800, 1750. This kind of line here, 1764, 1765 would be a reasonable retracement level to see gold at if the bonds and the US dollar retrace, as we were just discussing. Now, what could easily happen is that actually people start losing faith in the common denominator between the two, and that is the US dollar. I've been looking at why gold should take out the all-time highs and go a lot higher, which is actually what the spread that I will show in a moment between the bonds and gold is showing, that we could potentially go dozens of percentage points. And that can only happen if people start losing faith in the common denominator between the two, and that is the dollar. Now, that would imply a Dixie somewhere around 90 or in the high 80s. That would also imply not necessarily a big change in the bonds, but certainly should imply a much steeper curve, because people will not be comfortable owning 30s in a currency that's rapidly depreciating. A currency which is rapidly depreciating basically is a loosening of monetary policy by other means, and that tends to inevitably at some stage lead towards some kind of inflation. So they should really steepen the curve by, a couple of dozen basis points, if nothing else. So that is what I'm seeing, and I will now show you the spread and why I think that we are at a very pivotal level. Okay, here we have the relative performance, but don't forget that this is without dividends and the coupons. TLT over gold and SPY over gold. As you can see, basically they tend to follow each other. These are the same time periods. As you can see, this is basically 03, 04 here, and this is 04 here. We are at this very, very important line. We just closed below it in the relationship against TLT, and we are just about at the same kind of level, and this very important relationship with gold and SPY. So basically, against both asset classes, gold is at a very, very crucial level. We are, as I said, at a crossroads. Either we move substantially higher from here, or we break down and move substantially lower. What we will not be is anywhere near here in the next 6 months, in 6 months' time. So, what do these markets all have in common? They have in common the US dollar as a denominator. Gold is denominated in US dollars, SPY in US dollars, TLT in US dollars. And therefore, if TLT doesn't move very much, and I don't think TLT by itself will move relatively that much, because the Fed is not going to change its policy, the Fed is still going to be on the bid. I just can't see them losing control of TLT. But I can see them losing control of the dollar, because they don't have control of the dollar. They don't care about the dollar. They, if you ask the Fed what its policy is towards the dollar, they're going to say it's not our responsibility, it's the responsibility of the Treasury. If you ask Mnuchin what his dollar policy is, going to say, let the market take care of it. Okay, well, the market might take care of it, and you might not like it. So this is, to me, the only, either we bounce now and we go back towards 120 and, the world is fine and nothing has happened and, everything is beautiful, or these relationships in the next 6 months are going to change quite drastically. I would not be surprised to see gold against bonds down here around 78. But that implies a 15% move, and if it's not going to come from TLT helping, i.e. going halfway with gold, that means that 90% of the move is going to be in gold, and that implies another $250 higher in terms of gold. If gold is $250 higher, why is that? Well, it's not because the bonds have moved very much, and in that case it has to be because the dollar has moved very much. What I'm trying to really argue, and this is important, is that the current relative levels of volatility in the markets, i.e. the current level of volatility in SPY and TLT and GLD, are going to be very, very different in 3 to 6 months' time. And don't forget Dixie as well, or Euro USD, whatever you prefer. If those levels don't, those relationships of volatility don't hold, we're going to have a much, much different market in 6 months' time. I wanted to, again, before I go into the equities, show you these charts, because to me they're beginning to be shocking. XLF over SPY, XLV over SPY, XLI over SPY. Basically, XLF has really not moved at all from the lows that it made, sort of when the market was at 2200. XLV, as the largest of these sectors, is basically not really moving much higher, is it? I mean, it cannot break this 33 level, which I told you was very important, straight back to the 200-day moving average. Okay, this basically is dead. So XLV is going to be a market performer. And XLI, you know, again, straight down to where it was when the market was 2200. So basically, XLI and XLF are not helping at all. Let's have a look actually at their relationship with XLK. Okay, and here we have the exact same XLF, XLV, and XLI, but instead of against SPY, it's against XLK. Same chart, right? This is the only one that's different, i.e. this one is weaker. So as you can see, everything is in the sign of XLK. XLK is your common denominator, and why is XLK going up and up and up? And I think now it's more likely to do a a complete bubble moonshot. It could, I don't know, go up by 50%. That kind of ridiculous number. Well, because that is, if that is the only thing that is rallying and has momentum, then if you actually debase the denominator, i.e. the US dollar, it's going to go up even more, isn't it? I mean, XLK basically has got everything in its favor. The dollar, and because let's face it, software companies get a lot of their earnings internationally. The dollar is going down. Long-term yields are low and going lower, and that is your multiplier. So there is nothing which is stopping XLK from going up. The Nasdaq is just on fire. Earnings are brilliant, but you'd expect earnings to be brilliant because of the factors that I've just told you. If the dollar is going down and if the multiplier is going up, it's all going to go to the moon, basically. And that is what these charts are telling you, that it's all in the sign of XLK. Okay, so if it's in the sign of XLK, then we have to look at the levels in the Nasdaq, which become completely ridiculous, but don't think that we can't reach them. Let's have a look at volatility in Nasdaq as opposed to S&P. It's got a very clear level around the 30% mark, where when it closes the week above it, bad things happen the 1-2 weeks afterwards, and it basically goes up quite significantly, to around the 40 level, if not the 50 level. When it closes below 30, it tends to continue down and remain subdued, and the market can go substantially higher. You can see how basically it really hasn't changed very much, volatility, since what is this? This is what month is this? This is basically April. So volatility is remaining elevated while the market is still below 30. To me, that tells me that the market is going to start going higher and staying higher in Nasdaq for quite some time. So volatility is confirming sort of upward trajectory without the strong possibility of a breakdown. We will know when the breakdown occurs because it'll close the week around 30, above this 30 level. Until while it's below this 30 level, I think the Nasdaq will keep on going higher. Well, we have some very, very clear levels in the Nasdaq. To me now, 10,300 on a weekly basis is absolutely key. Look how beautifully we're holding this moving average. It's faultless. But also we have 1, 2, 3, 4 weeks now, I mean a whole month, that we've traded above it. Touched it a couple of times, straight back up. And now we have 11,050 or thereabouts as your break level, and you just go with it. I mean, what I'm going to do and what I keep on doing is buying 10,300 calls. That makes me long the market, and I also have a put below, and therefore I'm out if it starts trading below. But also what it does do is give me the possibility of still being in if we have a false break. It's the same as buying the market and buying the 10,300 put. So that to me is a sensible strategy. Why? Because if you just look at this area here, basically what is that? That is 700 points. We will go, if we start going up, we'll go 700 points on 11,000. That's 11,700, which basically in the next couple of weeks we touch the upper Bollinger Band. That is a big move, okay, and it could just go parabolic. It could just go parabolic because I've had a look at all the individual shares, but the big ones like Apple, Amazon, Facebook, they could go 20%, and that by itself will drag the market 700 points. So what I'm saying is that the surprise of everybody looking for some sort of a summer lull is actually could be the surprise could be that we go a lot higher. I think the odds are now that we develop into a true bubble going into the election in Nasdaq, because it's the only one that is dragging. And that makes sense, because if they keep on weakening the dollar and keeping interest rates at these long-term interest rates at these very, very low levels, why not buy Nasdaq? I mean, why on earth not? Everything is in its favor. For those who prefer the S&Ps, or they have to be in S&Ps because of the performance related of the S&Ps, the level is very simple. 3,200 in SPX. We tried 2 weeks to touch it and go below it. That's that 3190-ish level in ES. Every time we got anywhere near it, we just bounced straight off it. It won't break. That is your Rubicon. It goes below there, you want to be out, you don't know what's happening, but in the meantime, I think we trade 33.37. That is the level that I would not be surprised at all to see in the next 1 or 2 weeks. If we go down to a daily and amplify it a bit, it's very clear where that 3,200 level is. It'll be below this red line. It's not going to happen very easily. The market is holding that red line beautifully, that red moving average, which is coming up. It closed, well, it couldn't be a better close. I know why they did it, because they want to stuff the pension funds with the monthly flows. The pension funds normally come in on the 1st and the 2nd of the month to buy. I think it just expands and trade 33.37. So you can see it. It's the same level. 33.37 is your next resistance level, where it could do something like this. A couple of days and then back down. A couple of days up here, back down towards the 32.50 level. Would not surprise at all. But it's going to be led by Nasdaq. It's quite obvious that none of the other sectors, and those sectors that I showed you are 50% of the S&P, and they're doing nothing. Absolutely nothing. So the Nasdaq is doing all the heavy lifting, and the rotation in and out of Nasdaq is actually doing everything, all the heavy lifting. And why bother to trade everything else when the only one that has everything at its back is Nasdaq? Having said all this, actually what is very interesting is that the fact that the relationship in the volatilities between these different asset classes that I've been discussing today cannot stay as it is. It's just impossible mathematically. And therefore on Monday I will discuss a volatility trade between those three asset classes, which could actually be the biggest mover for the rest of the year. Thank you very much indeed, and tweet you that on Monday.